Welcome to Shet Vidya Mandir online lessons. This is the fourth part of our chapter, Introduction to Partnership and Partnership Final Accounts. Earlier, we have already taken 3 online lectures. First was Introduction, then was Methods of Capital Account, and third we solved a sum on different types of capital accounts. Now, moving forward, let's see how to prepare financial statements. What are final accounts? Final accounts are financial statements which are prepared at the end of each year. Financial statement is divided into two parts, the income statement and the balance sheet. Income statement further comprises of trading account, which is made on the basis of direct expense and direct income, and profit and loss account, which is made on the basis of indirect expense and indirect income. The result of trading account is gross profit or gross loss, and the result of profit and loss account is net profit or net loss. Balance sheet is a statement which shows all the assets and liabilities of the firm. Trading account is a nominal account. This is a part of income statement which is prepared on the basis of direct expense and direct income of the business concern. Trading account is prepared for the purpose of calculating gross profit or gross loss of the business for a given period. The balance of trading account is carried to the profit and loss account. This is a specimen of trading account. Let us discuss the different items, accounting items that appear in the trading account. Now let's see the debit side first. See the debit side? The first is always opening stock. The stock of goods that are in the godown in the beginning of the accounting year is called opening stock. Opening stock is always recorded on the debit side of trading account. Next you see is purchases. This purchase means the goods purchased during the accounting year for resale. It includes both cash purchase and credit purchase of goods. Purchase returns are deducted from the total purchases. However, purchase of assets, stationery, and all these things should not be included or added in purchases. Next is direct expenses. All expenses which are incurred for purchasing or manufacturing of goods or services are called direct expenses. In other words, expenses which have direct relation with the production of goods or services means direct expense. They can be wages, they can be carriage, octroi duty, custom duty, factory rent, factory insurance, motive power, coal, gas, water, royalties, trade expense. All these things are your direct expenses. Now, see on the credit side, the main two items in the credit side are sales. Sale means the total quantity of goods sold by the business enterprise. Sale is the main source of income of trading organization. This includes both cash and credit sales. Sale of fixed assets is not included in sales. Next is closing stock. The stock of goods which it is not sold, which remains unsold at the end of accounting year, is called closing stock. This value of closing stock is credited to the trading account. Suppose two values of closing stock are given to you, the cost price and the market price, then whichever is lower, that you will take as closing stock. So this is the specimen of trading account. Profit and loss account is second part of income statement. It is prepared on the basis of indirect expenses and indirect income. It is a nominal account. It is prepared to find out the net profit or net loss of business. This net profit or net loss is transferred to the partner's capital account. This is a specimen of profit and loss account. Now, profit and loss account being a nominal account, all of you know what are the rules of nominal account. Debit all expenses and losses, credit all incomes and gains. Now, all indirect expenses will be on the debit side and all indirect income will be on the credit side. Now, what is indirect expense? It could be of many types. It could be office and administrative expenses such as printing and stationery, postage, telephone charges. It can be selling and distribution expenses such as carriage outward, advertisement, warehouse expenses, packing expenses. This indirect expense could also be financial expenses such as interest on loan borrowed, interest on capital, bank charges, interest on bank overdraft. Depreciation is also debited because depreciation is a loss. Any other abnormal or unusual loss like loss by fire, loss by theft, that is also on the debit side of profit and loss account. Also, you have bad debts and reserve for doubtful debts on the debit side. Now, any indirect income or gain will be written on the credit side, like rent received, commission received. You can see here interest on investment. Balance sheet is not an account. It is just a statement showing the financial position of firm. All the assets and liabilities of the partnership firm are shown in the balance sheet. Only real accounts and personal accounts are shown in the balance sheet. And where are the nominal accounts shown? The nominal accounts are shown in the trading account or profit and loss account. Nominal accounts are not to be shown in the balance sheet. The asset side must always be equal to the liabilities side. Now see, this is a specimen of a balance sheet. Balance sheet comprises of asset side and liability side. Because it is not an account, the words to and by are not written on the balance sheet. Now see, this is the asset side. Assets can be fixed assets or current assets. They can be tangible assets or intangible assets. Fixed assets are assets which are held in the business for a long period of time. Example, land and building, furniture and fixtures, loose tools, machinery, freehold property. All these things are fixed assets. Intangible assets do not have any physical existence. Example is trademark, copyright, patents. They are also shown on the asset side of balance sheet. Current assets, assets which are held in business for short period of time, say around a year, they are called current assets. They are cash in hand, cash at bank, debtors, closing stock, bills receivable, prepaid expense. All this is recorded on the asset side of balance sheet. Now come to the liabilities side. See, liability side, partners capital account, partners current account, general reserve, this is the saving of the partnership firm. Then loan from partners, you can be liability side will show long term liability like capital, bank loan, loan from financial institutions, or they can show current liability. Current liabilities like creditors, bills payable, outstanding expense, bank overdraft. All this is to be shown on the liabilities side of balance sheet. And at the end of the year, you see the total asset side total should be equal to the liabilities side total. Your assignment, you have to find the odd one out. See the first one, wages, salary, royalty, import duty. Now wages, royalty and import duty go to trading account debit side, but salary goes to profit and loss account debit side. So odd one is salary. See the second one, postage, stationery, advertising, purchases. Postage profit and loss, stationery profit and loss, advertising profit and loss, purchases is trading account. So purchase is the odd one out. Third one, building, machinery, furniture, bills payable. Building asset, machinery asset, furniture asset, bills payable, liability. So which is the odd one? Bills payable. Now see fourth one, capital, reserve fund, bills receivable, bank overdraft. Now only bills receivable is asset, rest all are liabilities. So your odd one is bills receivable. Discount received, interest received, dividend received, depreciation. Now all three are receipts. Discount received, interest received, dividend received, profit and loss account credit side, and depreciation is your loss. So profit and loss account debit side. So this is the odd one out. Okay. We shall meet again. Take care. Thank you.